Welcome everybody, I'm Dave Wagner. Welcome to Tidecrest Capital Currents. Today we're talking about the volatility we've seen in the marketplace last couple of days, really substantial historic volatility. Going to run through a few stats, kind of what's going on in the markets, talk about the volatility we're experiencing, a little bit of monetary policy, and then there's actually a few silver linings I want to mention as well. So, first, over the last 2 days, global capital markets have had significant volatility. Today really kind of made it drop even further. One of the main catalysts was China announced kind of retaliatory tariffs of 34%. Major averages kind of across the board in the U.S. off 5.5% to 6% today. S&P is down 17% from the peak. It trimmed $4 trillion in value in the S&P just in the last 2 days, which is incredible. NASDAQ's in the bear market territory. That's defined by being down more than 20% from its peak. And Dow experienced the third worst price drop in terms of numbers in history. So it's the fourth time you've had more than 2,000 points come off the Dow. The other three were in the heart of the pandemic, right? So it is a substantial historical time these last few days. Crude oil prices also dropped to 2021 lows, and the 10-year Treasury dropped below 4%. So that's a little bit of kind of a scorecard for the market the last few days. Those are all meaningful numbers in their own regards. Also volatility. So the volatility index, we've talked about this before in our calls, in our videos, went above 45 today. To give you some context, last summer's yen carry trade, significant volatility in August was like 42, 43. If you go back before that, you're not seeing a VIX in that plus 45 range since COVID. And then go back further and you kind of graze a couple like the European debt crisis and stuff, but really it's not until the financial crisis. So you're talking about above 45 on the VIX has happened, this is the third time it's happened in 20 years. And so we're seeing that. To give you a little more context, both COVID and the financial crisis were closer to 80 than 45, so substantially higher than what we're having now. But we're starting to get into a territory being the third highest, in 20 years is substantial, clearly, and something worth noting. There's some important differences between COVID and the financial crisis and right now, whatever you want to call it, the tariff volatility, tariff markets, Trump's tariffs, whatever, is it is man-made. So nobody, I think, back in 2008 or 2020 really had any expectation or hope of a quick turnaround. There is the reality is that this is self-imposed, and that if trade policy changes for whatever reason, there's a variety of ways we can get there, that we feel like a lot of this could turn around rather quickly. So a lot of this hinges on how long these tariffs stay in place in terms of how impactful they're going to be and what long-term impacts they may have and damage they may do if they stay in place for a long time. A little bit about a monetary policy. So the Federal Reserve Chairman Jerome Powell did speak today. It wasn't like a scheduled speaking. I think he was speaking at some other conference, but he had some comments. And basically, the summarize, it was larger than expected tariffs. Everybody expected these tariffs. We did a video a few weeks ago on the general tariffs, kind of 10% across the board, 25% on Mexico, China, and Canada. And clearly we went way above that. I won't get into the tariff rates right now, but we're well above that. So he's saying larger than expected tariffs, larger than anticipated economic impact, right? He's talking about increasing inflation is likely going to go up, which is pretty obvious. Prices are going to go up. People are going to have to spend more. And so we're going to see inflation probably. So it's going to be a little bit of a down drag on their battle against inflation, which would mean inflation would be going maybe up a little bit. But he said it's too early to tell what the overall impact will be on the economy. I think a lot of it has to do with how long these will stay in place. Biggest concern for the Fed, and really for a lot of market participants, is stagflation. That's a stagnating economy with inflation. And the reason that's a challenge is because the Fed really can't do much about it to help with monetary policy. So what would happen is if you have a stagflation in the economy, you can't lower rates to stimulate the stagnating economy. And you can't, because if you did that, you would offset and you would make inflation maybe too hot. If you have inflation, you can't fight that by raising rates because you have a stagnating economy. So I'm not sure if I explained that perfectly, but I hope you guys get the point. You get kind of trapped in there where the Fed really can't do much about it. So that's main concern. A few silver linings, though, I would say. One is diversification is working. So back in 2022, everything went down. Rates shot through the roof. Bonds were down. Worst year ever for bonds. And equities were down. Now we're seeing bonds are performing pretty well. Gold is performing pretty well. A few other asset classes are doing reasonably well. So if you have value and quality in the portfolio and some of these other areas, you're actually seeing relative outperformance compared to some of the growth names and kind of broad equity markets. It's also based on the markets and futures. It's showing an increased likelihood of Fed funds cuts in the near term. There's no way to really know exactly what that'll be. A lot of it depends on timing of the tariffs, if they stay in place or not. But right now they're pricing, significantly. I think it's up to 3 or 4 Fed cuts this year if the tariffs stay in place versus before this. I think it was 1 to 2. Mortgage rates have dropped. There's another silver lining, dropped 20 basis points in the last 2 days. Lowest rate since October of 2024. Home building stocks were actually up today. Down 17%. The S&P is down 17% from all-time highs. A typical recession is down 24%. So you can make the case that a lot of this is already priced in. Maybe a shallow recession is already priced in the market. So we see that as a good thing in terms of prices have come down to adjust to the uncertainty. There's also rumored conversations with important trading partners such as Vietnam. There was a story that came out today saying Vietnam was negotiating to get their tariffs down. It kind of boosted the market, and then that excitement went away. I'm not sure if it was true or not, but that was a story that came across the headlines today. And then the other thing is the sell-off's been large, but it's been orderly. So what that means is it hasn't been panic selling indiscriminately. We talked about home builders were up today. We talked about how the bond market's performed reasonably well. It's not like everybody's rushing to get liquidity and selling everything. So that's been it's been an orderly pullback, although it's been really dramatic. And then in closing, always review your financial plan. Have some context when you're looking at the markets. Verify your time horizon. If you're long term, I'm not as worried. If maybe that it's evaluated and it's become down for you, it become shorter in the last little while, a couple of years or quarters, you should be aware of that and start thinking about access to capital. And then use this as an opportunity to evaluate your own risk tolerance. We learned in COVID and in the financial crisis that people overestimated their risk tolerance. So even if you're hanging in there for the long term of these portfolios, which we recommend if you have a long time horizon, think about how this is making you feel and really evaluate your risk tolerance to kind of put some changes into your financial plan if you need to. And of course, reach out with questions. We're happy to talk to you. So subscribe to the YouTube channel if you want to hear more content like this. Click on the link for the website below. Connect with us on social, on Instagram and LinkedIn. And until next time, thanks for listening.